much indeed, Rob, and just to echo Rob's very warm welcome to everybody for joining. It's very good of you, and I hope you find this interesting. So I'm guessing that we're all probably keen to make a start. So Mark, I'm going to turn to you to begin with. I think it's something of an understatement to suggest that 2020 was a fairly exceptional year for everybody, and no less so for the property sector. COVID obviously was the big issue, and we're still feeling the effects of that now, or hopefully there's a little bit of light at the end of the tunnel. But there were a few other headwinds and challenges that the property sector had to deal with, weren't there?
Yeah, thanks, David. It's certainly been a difficult time for everyone, and there's been a number of market issues that have directly affected the property real estate sector. It's been well documented that we're in a hardening cycle of the commercial insurance market, and the first real property-related issue we saw in respect of this was the flooding in Q1 of 2020. This resulted in an influx of flood-related claims and incidents that put a huge strain on insurer resource and severely affected their bottom line, essentially. Insurers spend huge sums of money on their sophisticated postcode flood mapping systems that are used to underwrite flood risk, and very rarely deviate away from the results and recommendations that these systems offer them. The Q1 2020 flooding had a severe impact on the output of these results, meaning that insurers quickly revised policy offerings on troublesome postcode areas by way of increased flood excesses, or in many cases, no offer of flood cover at all. Just as insurer claims departments were starting to make progress on the settlement of these flood claims, the COVID-19 pandemic hit. As we all know, the pandemic has had a huge effect on the global economy, meaning firstly, insurers' investments are struggling, with low interest rates seen as a result of the stock market losses. Together with this, insurer claim reserving and claim settlement figures are much higher than anticipated, meaning operating profits are obviously lower. Solvency II regulations also now require insurers to hold additional capital to cover potential losses, and then throw Brexit into the mix. This adds complications again. Insurers have also had to invest in areas of the business that they were not budgeting for, such as changes to technology to support home working or remote ways of working. All of these issues have meant that insurers have to go back to the drawing boards in terms of setting their financial targets and overall strategy. Unoccupied property has been a direct consequence of COVID-19 for the property sector. Challenging tenant types include retail and hospitality tenants, shall I say, two sectors which have been previously bread and butter to insurers have now become problematic due to the continued uncertainty that COVID-19 has had on tenants' ability to trade and, as such, occupy premises. As Rob previously mentioned, the FCA test case on business interruption has also contributed hugely to the uncertainty in the market, especially with last Friday's ruling in favour of policyholders. We at Thomas Carroll are currently in the process of reviewing the findings from the case with our legal representatives to ensure that we continue to give our clients the best possible advice moving forward. Lastly, it's worth mentioning some market issues we are seeing in respect of the fabric or construction of buildings. We're still seeing a huge amount of insurer resistance to non-LPCB approved panelling or cladding as a result of Grenfell, with insurers now wanting to know chapter and verse on exactly what these panels include or contain. We've also encountered some challenging insurer responses in relation to modern methods of construction, such as built off-site and modular type builds, simply where underwriting teams do not yet have the expertise to understand these risks fully. Overall, the above issues, primarily flooding and COVID-19, have meant that reinsurance capacity is shrinking and their rates are increasing. Insurer profit levels are therefore reducing due to claim settlement figures and future consideration for long-term claims. So for this reason, insurers are looking to push premiums, tighten terms, withdraw from certain markets, and are generally being more restrictive in their appetite.
Yeah, thanks, Mark. I mean, that's a pretty complex backdrop. So I'm guessing that one of the questions that many of our audience guests would like me to ask on their behalf is how exactly does a property owner position their portfolio in the most positive way?
Yes, obtaining favourable property insurance terms in the current market may sound daunting based on my previous comments, but by following some simple guidelines around good practice prior to placing cover or prior to a renewal cycle, the insurance buyer can put themselves in the best possible position to obtain favourable terms. My first piece of advice really would be around getting prepared and starting the process early. Appreciate that everyone is busy and external factors mean that it's not always possible to have lengthy lead times. But with the current market state, we need as much time as possible to engage with the market and sell the risk to insurers. Underwriters' first response to quotation requests is now typically no, rather than yes, what it has been in previous years. There's also the added factor of longer response times for insurers whose underwriting teams may be smaller or less resourced as a result of their reduced budget. Some insurers are also struggling with the impact of remote working and are simply not as efficient whilst working from home, unfortunately. Essentially, in a market where capacity is low, but the number of inquiries received by an underwriter remains high, the best risk presentation wins the underwriter's time. For us as brokers to fully understand the risk and do the best job possible, we would typically ask for 2, 3, or even more months' notice on larger portfolios, where we can look to engage with the insurer early and potentially use pre-cover surveys or other trading methods to obtain best terms. However, I will say that this is obviously an ideal scenario, but with our in-house delegated authority property teams and facility arrangements with leading insurers, and partners, our specialist teams are also geared up to turn around quotation requests quickly when required, including then those with funding and banking requirements and/or legal indemnity considerations. For us as the broker to have the best shot of obtaining favourable terms, my second piece of advice would be around the importance of the insurance buyer or client providing robust risk detail around the property or portfolio. This is something we guide our clients on regularly, along with taking the time to understand our client's business fully to help them identify the additional information that insurers require outside of the traditional proposal form. The more relative information received around security of the building, the construction, occupancy, risk management features, etc., can help us to present the risk in a more favourable light to insurers. At this stage, it may be then worth considering implementation of additional risk management controls, such as improved health and safety features, which will again please underwriters. Insurers are asking for far more information than ever before, and the Insurance Act of 2015 puts the onus on the policyholder to provide the relevant risk information required. I would also like to emphasise the importance of getting the property reinstatement sum insured correct. Statistics around real estate in the UK that is underinsured is alarming. I think it's circa 79% of property that's underinsured at the moment. And in the event of a claim, if your reinstatement sum insured is too low, average will be applied by the loss adjuster, meaning that your claim payment would be proportionately reduced and therefore insufficient to meet rebuilding costs. The other side of the coin, of course, is being overinsured, which means you're giving away unnecessary premium. So it works both ways. Lastly, while it may seem proactive to take your insurances to market on an annual basis, in the current market cycle especially, we may only encourage this if you have a specific issue with your current provider. Strong and long-lasting relationships are preferable to underwriters who may decline to quote risks where the policyholder is seen in the market as a shopper. Insurers will often reward businesses that market in longer intervals of, say, 3 years via offering attractive terms rather than those who do so every year.
Yeah, some really interesting stuff there, Mark. Thank you very much. A lot of food for thought. Final question for you, Mark. I know that you and your team very much pride yourself on providing a sort of a boutique service for London-based, excuse me, property owner clients. I wonder, before we move on, whether you could share some of the solutions that you've seen developed over the past year or so.
Yes, of course. Aside from the core broking services we offer our clients, we try to think outside the box and focus on more niche, added value, tangible solutions that can help our clients navigate through the market issues I mentioned earlier. In terms of problems around flood cover and water management, in instances where the market will not provide flood terms, we have access to a specialist product called Flash Flood that offers an alternative to the traditional flood peril insurance by way of a mobile connected sensor system that is installed at the property. This sensor then reports any flooding over a pre-agreed trigger depth, and the provider pays a chosen claim settlement amount to the policyholder. This effectively gives the client the same peace of mind that traditional flood coverage would. With the further hardening of the market caused by COVID-19, we also look at creative ways to offset premium increases and the tightening of terms. So for larger property portfolios, this could include moving away from traditional one insurer property owner policies to more layered style programs, with the risk then split across a range of insurers, thus increasing appetite in the market. We also advise around adjusting excesses and deductible levels on a program to obtain further premium efficiencies. As Rob mentioned earlier, we have an award-winning in-house claims team with a host of loss adjuster experience that are currently navigating our clients through the FCA ruling and what this means to their policies. Further to this, we offer claims defensibility health checks that help support our clients in building a strong health and safety culture within their organisation. If further support is then needed, our OSAS 18001 accredited health and safety team are on hand to advise. We always look to have a holistic approach to risk, David. So rather than just focusing on the transactional insurance side, together with our health and safety offering, our group services also include HR and employment law advice, wealth management, employee benefits, personal insurances. So we really do offer the full and broad risk management solution. We regularly offer confidential audits and risk mapping exercises to our clients and prospects to identify and manage their overall business risk, reducing the amount of risk transferred to the insurance market and creating bespoke programs for their needs. We always work with our clients and prospects to help control the impact of internal and external factors to their business. I spoke earlier around the difficulties with non-LPTV approved composite paneling or cladding. When we're advising on a risk where the client is unclear what cladding is in situ from the construction files, we would always advise our clients to seek the services of a qualified cladding expert who can offer a survey and report determining the exact type of cladding. We've seen instances where the front-end cost of this service provides further clarity to insurers who go on then to offer better terms, meaning the cost of this service is sometimes offset anyway. I'm obviously happy to share further details of reputable firms that offer this service if required. I mentioned earlier the importance of obtaining the correct reinstatement sum insured of a property to avoid under and over insurance. We have partnered with a company called Rebuild Cost Assessment Limited, who offer our clients a cost-effective solution to undertake this exercise. RCA Limited are RICS qualified surveyors and are able to assist with all types of property risks across many sectors. Again, a small cost on the front end may not only save on premium in the long run, but will undoubtedly give you the peace of mind that your insurance program is on the correct basis. From a lending obligations perspective, we carry out due diligence audit service for several clients to ensure compliance with financial agreements, specifically in relation to insurance. And lastly, we have a specialist legally qualified legal indemnities team who can advise around restrictive covenants, right to light, defective title, etc. This way, our clients receive impartial advice and have access to broader legal indemnity markets via our established relationships and buy-in power, rather than having to go to the insurer direct.
Okay, thank you very much indeed, Mark. I mean, there's a lot of excellent food for thought in all of that. Before we move on, just a quick reminder to everybody in the audience that if you do have questions, you have a question submission box on your right-hand side, and we'll try and pick up questions at the end. If we don't get to all of the questions, we'll certainly come back to you following the webinar. Thanks very much indeed, Mark. Some really useful tips in there. Paul, if I may, I'd like to turn to you now to talk a little bit about the construction sector. As with property owners, there's been a lot of interesting headwinds over the past 12 months. I'm suggesting you're seeing quite a few common trends developing, aren't you?
Yes, we are. Thank you, David, and thank you, Mark, and welcome everyone. Yes, I mean, the construction sector has challenges across the whole piece, and a lot of what I've got to say echoes with comments that Mark has made about some of the macro and microeconomic challenges that we've got. But I thought it'd be helpful to provide a brief overview of the key classes of insurance that sit under the heading of construction sector, to give some context to the challenges we're facing in an increasingly volatile market, and how these are linked, and whether you're a contractor, developer, or funder. As you'll hear, there are a number of consistent themes and common messages that need to be addressed. As a broker, I regularly act for all types of client in the development chain, but notwithstanding that, it's vitally important that a clear and consistent message is given about what's happening in the market, since it will ultimately determine what is and what is not within the gift of contractors and developers to offer, and of course for lenders to accept. So I'd like to focus on three key areas relative to commercial and residential developments: contractual risks, structural warranty, and professional indemnity. PI being the main one that we will be focusing on later on. So for the contractual risk market, the position has changed significantly in the past 24 months. We've had significant major losses. The Ocado warehouse fire in Andover, £94 million. The Glasgow School of Arts fire, the second one, £100 million. And the Primark site in Belfast adds another £30 million of losses to the sector. If we then add in Home Office fire stats on construction sites for England, between 2014 and 2019, there were an average of 370 fires a year. Worryingly, 62.5% of those were deemed to be accidental, which suggests then that 37.5% of those were deliberate. But an increasing concern, and this was mentioned by Mark earlier, was the concern underwriters have about the scale and volume of internal water damage losses, particularly in relation to large vertical structures. For many underwriters, this is overtaking fire as a principal risk concern. So against this background, what's been happening in the market generally? Well, over a dozen carriers have left the market, taking in excess of £1 billion of capacity with them. This in of itself has resulted in increased pressure on rates. Layering and scheduling of contract limits is now necessary to secure capacity as underwriters seek to limit their exposure to any one loss. There's certainly more scrutiny on panelling systems, as Mark has alluded to. There's far greater scrutiny of projects, particularly above the £5 million build level, with pre or post cover surveys now becoming the norm. Excess or deductible regimes, these are the self-insured losses carried by employers or contractors. The £1,000 to £2,500 are now regularly being replaced by the £5,000 and £10,000 levels. Escape of water, very often we're seeing £25,000 to £50,000 depending on the scope of the project. But then who's responsible for these? If we're looking at the value of the project and the prelims and the costs, how do you account for some of those deductible regimes? There's also increasing resistance by some underwriters to targeted lender requirements at a time when these are becoming more and more important to funders. And sadly, the term gratis seems to have been removed from the technical underwriting manual. Underwriters seem to be wanting to charge for everything. Very unfair, but perhaps also a sign of the times. So for the construction market, very much a competitive marketplace, but still with rising rates and greater technical underwriting scrutiny. But what about the structural warranty market? Now, during the pandemic, projects have invariably been delayed, not necessarily cancelled, so the demand is very much still there. The government initiatives, such as Help to Buy and Stamp Duty Holiday, have certainly helped maintain this demand. But if I was to categorise the market, I would call it turbulent. Premium rates are stable, but with a rising trend. However, supporting engineers' costs are increasing in response to pressure on PI insurance premiums. Following the collapse of carriers such as Alpha and CRL, there's certainly far greater scrutiny than ever on insurer security ratings. There are operators in Malta and Gibraltar that can provide the capacity, but are these the companies we really want to do business with certain financial restrictions in place? But I guess by far the main challenge we've experienced is greater interrogation by underwriters of the developer and the contractor experience. their respective financial position and technical scrutiny of the project itself. And of course, the choice of carrier is still dependent very much on acceptance through the UK Finance Handbook to satisfy the mortgage lenders. But there remains active competition and plenty of carriers, but it's very much about finding the right underwriter for the right risk whilst continuing to satisfy lender requirements.
Yeah, I think you used the word turbulent, Paul, which is probably the understatement of the year, but thank you for that. I know that a lot of our audience is going to want to talk a little bit or hear a little bit about professional indemnity. But before we do that, there's a lot of interest in the state of the surety market as well. I wondered if you could briefly share with us your views on what's happening in that sector and whether it's a cause for concern.
Yes, certainly. Surety sector is an area where we're still seeing a huge amount of activity. As we said, a lot of the projects were delayed rather than cancelled. And I have to say the surety sector is in pretty good shape. There's little sign of significant change in the short to medium term. I mean, contractor insolvencies did trickle in 2019 and gathered a degree of pace in 2020, especially in the 20 to 150 million turnover bracket, but no great concern at this stage. But there remains constant and persistent demand for financial security from lenders and external stakeholders, and this is keeping the market buoyant. Unique to us in Wales, the Welsh Government decided to withdraw surety support for HAs and RSLs at the end of August. That's created fresh challenges in the market for these organisations, but is also helping to create that demand as well. There's definitely more forensic due diligence being carried out, and for many organisations, cash collateral, personal guarantees, and counter indemnities are increasingly being sought to support that balance sheet position. There's definitely evidence of reduced facility offerings in the main and less flexibility on certain bond wordings. Some of these changes in wordings being driven by the funding market. But in the main, I'm satisfied that the market's in good health, David, and ready to meet the challenges for the next 12 months. It's ironic that a lot of the contractors have become victims of their own success because insurers will give a certain degree of capacity relative to their balance sheet. With contractors having good workloads and pipeline of work, that's becoming a challenge. But no problems at this stage, as far as I can see.
Well, that's quite reassuring to hear, Paul, and I almost hesitate then to move on to the next topic, which is what are your views on the current state of the professional indemnity market?
Well, I'll try to add some positive tones in this section, but unfortunately, PI is one of those challenges that affects pretty everyone. You know, as brokers, we have PI, our finance colleagues, our funders, everyone. But the PI generally in relation to the D&B market, we've had a soft market for many years, certainly between 2003, 2018. But the past 24 months, particularly post the tragic events of Grenfell, have been especially difficult, with seemingly no immediate end in sight. The provision of PI cover sits within what we refer to as financial lines. So the accompanying classes include directors and officers liability, crime and cyber. At the moment, these are pretty awkward bedfellows, given the ever-increasing frequency and severity of claims across all those lines. To put some of this into context, in 2018, Lloyd's commissioned the Decile Review to address loss-making syndicates. It found that PI insurance was the second least profitable class, with 62% of syndicates recording losses over the previous 6 years. This was clearly not sustainable, and immediate corrective action needed to be taken, and so it did. Larger and more complex projects coupled with new and innovative construction methods, as Mark mentioned, modern methods, modular construction, etc., they're fueling underwriter caution that tends to blunt the underwriter's pencil somewhat. And of course, there's no doubt that developers and funders are asking for ever increasing levels of PI cover from contractors, architects, engineers, all of which adds to pressure on demand for market capacity. I think we also need to reflect on what PI cover, the basis of cover that we have. It's a claims-made basis, so legacy matters are very real for underwriters. The new insurer coming on risk from today is picking up those issues that occurred previously. So that's something that's taken into consideration by underwriters looking at particular risks. So what's been the effect of these issues? Well, as Mark has alluded to, reduced capacity. Appetite across the whole insurance sector is reduced. Many underwriters now only offering a primary million limit, whereas 10 million before would have been entirely achievable. Significant premium increases, and as brokers, we have that pain as well. Double digit in the main, but with 100% plus in many cases. As with the contract works, increased excesses. Minimum £10,000 now becoming the norm. But I suppose the most significant change is the withdrawal of occurrence, or what we call any one claim limits, in favour of aggregated offerings. Costs are now inclusive of a limit, whereas before they were in addition to. And as worrying, full cladding and fire safety exclusions, almost mandatory now across the market. So these are real and significant lasting changes that affect everyone in the development sector. And with seemingly very little room to negotiate, it's more important than ever to prepare thoroughly in advance of renewal discussions. So how, against that background, how do we navigate through this PI market? If I was to summarize the PI market, I would perhaps use the word broken. It feels broken, it feels as if there's no end to this pain. But at the moment, it's really about managing expectations, given current underwriter appetite and volatility. This is crucial to delivering a successful outcome, whatever that may look like for you or your company. So what steps can be taken to help manage the renewal of the programs, given the rather worrying tale of gloom and doom? For me, communication is key. Engage with your broker or risk advisor at least 3 months ahead of renewal. This allows time to fully evaluate the company's risk profile, determine what information you have, and more importantly, what you need to position yourself in the market. Prepare a supplementary pack. And again, this is echoing what Mark was saying about some of the property risks. Underwriters are under extreme pressure. Make it easier for them by having answers readily available. A proposal form can only say so much, so you have to be able to articulate why your specific business demands serious attention by underwriters compared to the hundreds of other risks that cross his desk every week. What features of your business stand out? What makes you special? Detailed CVs of the key principals, their experience, their successes, all of that matters. It absolutely matters. And be clear in the level and type of cover that you need. Don't be fixated on what you want, but what you need. Consider your existing and future contracts. What do the contracts say about provision of cover? The collateral warranties in support, do they match the contract? We often see a mismatch. And the tender pipeline, do you necessarily need the PI cover to support every contract? Can we reduce some of that exposure and reduce some of that cost? But early dialogue is absolutely crucial with funders and clients. We need to have that dialogue to ensure a smooth transition of cover from one basis to another, if that's what's likely to happen. Last minute is no good. If we look at risk mitigation, if you've had claims, full circumstances and post-loss control measures to prevent a recurrence. If it was an unfortunate incident, how likely is that to return? Can we give underwriters comfort that that's not likely to repeat? Risk management, we talk about it, but do we practice it? How do you manage and mitigate risk? How much of the exposure is primary, created through contractual and privity of contract, rather than contingent, where others are actually carrying out the design and providing that advice? How is that articulated to underwriters? How do we reduce that exposure level? Do you have robust reciprocal arrangements with subcontractors and subconsultants? Are you able to limit liability through contract? Now, this could be setting us up against our funders and our developer clients with my contractor's hat on, but there needs to be a good degree of proportionality and risk and reward. So there needs to be that dialogue. Marketing strategy, have a clear plan. The scattergun approach to no longer works. Underwriters, as Mark has said, want to look at specific risks that they have an interest in writing. Sending out a presentation with key, essential data is no longer necessary. The underwriter will put it to one side and focus on the one that has the most amount of data available to him. If the occurrence cover is no longer available, look at a higher overall aggregate to satisfy some of those concerns from funders and developers. We often give a 50% extra headroom on aggregated cover to offset against the occurrence provision, or a reinstatement provision to give additional comfort. There are ways and means of providing the right level of cover to give that comfort factor. Layering is more important than ever. If you need 10 million, if you need 20 million, don't be afraid to engage 3 or 4 insurers to fulfill that schedule. You may have no choice anyway, but it also may prove more cost effective. Different insurers have a different rating threshold per £1 million of cover, so explore that. But ultimately, we talk about communication, marketing. Engagement is fundamental. Talk to the funders and the clients. Not everything is within your gift, whether you're a developer, contractor, or funder to give. And after all, you can always blame insurers. We've got pretty broad shoulders.
Thanks very much, Paul. I think some really good tips in there. I'm quite conscious of time because we have a number of questions coming in that I'd like to be able to tackle at least some of them. But Paul, I would like to just get a brief overview, if I may, on your view of the appetite of lenders and the changing requirements and demands being made by lenders now.
Certainly, yeah. From an insurance perspective, there's been a notable increase in financial scrutiny of both the projects and the commercial standing of the contractor. We found that contracting clients that have the necessary skill sets, experience and successes have been rejected purely on the extent of their turnover relative to the size of the contract. It's not the complexity or the actual ability to deliver it, which is an issue here, which feels somewhat counterintuitive, but it ultimately ends up adding cost to the overall project. But at what cost? There's definitely a more cautious approach, with funders offering less flexibility when negotiating key insurance elements, in particular the levels and type of PI cover. We're seeing more influence from lenders and lenders' legal advisors, very often with significant demands for changes to standard forms of contract. If we take the JCT 216 D&B, last year, 108 pages of amendments to one contract. The JCT form is only 106 pages in total. You've got to look at proportionality and what commercial advantage we're trying to get from these contracts. In those instances where we've pushed back on some of those changes to the insurance clause, invariably they've been accepted. Surety bonds, I've mentioned, there's still insatiable appetite for those, but again, we're seeing some of those bonds amended to give some commercial advantage. The provision of on-demand bonds is within the banking sector, not the surety market, and certainly not in the current climate. Collateral warranties are still a very important element of protection, but again, we're getting those warranties changed with additional assignment requirements and insistence on occurrence PI cover, when again, it's not necessarily within the gift to give. Demands for excessive levels of PI cover relative to the size, scope, and complexity of the contract are still a feature. That kind of says to me, do the funders or their advisors really understand what PI cover is designed to do and what is and what isn't covered? There needs to be a debate around that. But as the insurance market hardens, there's more reliance as well on broker letters of undertaking. These are given as a professional courtesy, and brokers want to help clients to support these initiatives, but they can be very onerous. And again, as part of the change in the dynamics of the market, we're seeing very onerous terms being applied with very little flexibility to change. That's something that we have to consider going forward, because as brokers, we also have an obligation to protect our business and our balance sheet. And sometimes these are simply unfair. But I guess one of the most frustrating elements is the incorrect use or the nomenclature around some of the insurance terminology that's used. Issues around composite insured, co-insured, joint insured, interest noted and the like. We understand the importance of these, but very often the message is mixed, and we're trying to satisfy lenders who have a different understanding to what the insurance market has when we use some of those terms. So whilst some of the following are not new, underwriters are becoming increasingly less accommodating in offering full non-vitiation and non-invalidation clauses, freely assignable amounts and rights to the sums payable under insurance claims, and even lost payee clauses coming down to £25,000 or £10,000 when £50,000 was always the norm. We're also seeing more dictation of who become the accepted structural warranty providers, but with some collapses, perhaps that's not a bad thing. But where incumbent insurers are unable to or willing to accept lender requirements, funders are often now expecting new carriers to be found who will or can accommodate, but often at increased cost. A composite insured provision will often give you a 20% uplift on premium, for example. So the key message is about trying to have a sensible conversation with funders, direct, preferably rather than through their legal advisors, who, with the greatest of respect to our legal fraternity, very often don't appreciate the subtle differences between corporate and insurance law. The translation of words and meanings can achieve the same objective if the risks are truly understood and explained, rather than relying on a tick box approach. Ultimately, we all want to achieve the same objective, but need greater direct engagement with funders and an acknowledgement that it's not always within the gift of developers and contractors to comply with lender insurance requirements, particularly in the current climate. And of course, insurance is always the last box to tick, or at least it feels like it. So generally a lot of pressure to conclude. So as Mark has said earlier, early engagement is always preferred. In conclusion, we've got signs of a hardening market. They've been around for at least 24 months, the effects of which are more pronounced in certain quarters. But what is clear is that the pandemic is exacerbating an existing problem, sadly the consequences of which have yet to be felt for some time to come.
Paul, thanks very much indeed for that. Very insightful indeed. I'm conscious of time, and we have had a number of questions coming in, which I'd like to sort of move on to if possible. Just to again remind everyone that if you have a question, please feel free to submit it online or indeed after the event. And if we don't get around to answering your question on the webinar, then we'll certainly make sure that we follow up with an answer outside. So let me ask you a question, perhaps best aimed at Paul, but Mark, if you have a view as well, I'd be interested. One of the questions is there any evidence that the government is intending to offer either financial or capacity assistance for cladded residential properties?
From a construction perspective, I'm not aware that that is the case at the moment. What we are looking at is underwriter support where possible. Underwriters have a particular role to play when looking at the specification of buildings, and what we want to make sure is that from a construction perspective, the specification and the availability of insurance cover post practical completion is there to ensure that the transition from construction to operational cover allows a smooth transition, and we don't have a building that's suddenly uninsurable because we haven't done the homework in advance of that. From a government perspective, I probably need to come back to you on that, but I think the insurers are there to offer pre and post loss control support, and we should never forget that it's a three-way relationship, and for underwriters to be involved early stage is absolutely critical.
Yeah, thanks for that, Paul. I'm going to ask you an associated question, actually, because you referred to it being a partnership with insurers. But one of the questions that's come in is from somebody who's seen premium increases of maybe 200 to 300% on properties with a good claims track record. Is there any indication that insurers are trying to profiteer from the current climate?
Sorry, is that for me or is that for Mark?
I'll ask you first of all, then I'll ask Mark to come in as well. What are your views, Paul?
Okay, I mean, I don't think it's a case of profiteering. I mean, if I can look at it from a contract works perspective, as I said, the market is still competitive. Each risk is reviewed on its own merits, and I think it's the level of detail that's the crucial factor in determining whether the rating is consistent with the market norm or that you can get some preferential rating. I think there are ways to look at reducing total premium cost. But I think more than that, we need to look at the whole overall principle of insurance. You know, what we're looking at is collating premium into a pot out of which those large claims are paid. And I mentioned the Ocado, the Primark, etc. Those costs have to be borne somewhere. And it's unfortunate that within the principle of insurance, it's the premium pot that has to then be fulfilled later on in the day. But there are a whole raft of measures that can be used to reduce total premium cost. One of the options is to look at changing the structure of a program. If we have a higher general contract works level, you can start to strip out some of those larger, more complex contracts and do separate OSIP arrangements for those. So we risk wrap those. But I think it's all about making sure that you've got the best proposition to the market and that the broker does his job to get you options. At this moment in time, it's a case of looking at those options and taking a view.
Thanks, Paul. Mark, I'm going to ask your views on that as well, but as I do, I've got another question for you. So I'm going to ask you to do two at the same time, if you don't mind. We've talked about property and PI in particular as sort of seeing increasing issues with rates and capacity and so on, but are there any other lines of business that perhaps we have concerns around?
Yeah, thanks, David. In relation to other lines that are struggling at the moment, directors and officers cover, or management liability as it's also known, is the other main area really that's struggling. COVID-19 has intensified risks associated with director negligence and corporate manslaughter, for instance, which is a horrible area, but something that is under the microscope at the moment. Employment practices liability is also included in that type of product. So this type of cover is also seeing excess and rate increases across the board where COVID-19 has resulted in an influx of employment issues. Just going back to cladding and the question on cladding, obviously the government essentially has failed to deliver on their cladding promises. I think the number touted was that they were pledging 600 million for works on improving the cladding of some of the resi blocks around key areas that were problematic, but they've missed this target badly. So I guess we need to just keep putting pressure the relevant bodies, essentially, on the government to improve over time. But yeah, at the moment, unfortunately, the picture is that they've failed to deliver on their original promises.
Something of a shock, eh? Okay, Mark,
Indeed.
thank you very much indeed for that. And Paul, I'm conscious of time, and I don't want to run over, because I'm sure our audience has a busy day ahead of them. I think just to wrap up, I'd like to thank everybody again for attending. I hope you found it interesting. There are some people whose questions we haven't been able to get round to answer, so we will come back to you separately with those. And for everyone, as you heard from Rob at the very beginning, the session has been recorded, and you'll be contacted after today's event with a link that will take you to our website and to this particular recording specifically. In the meantime, thank you, everyone. The contact details for all of our team are available on the presentation. We would be very happy to reach out and help you with any particular individual inquiries or concerns that you have. And in the meantime, thank you all very much once again for attending, and I hope you all have a very enjoyable day and stay safe and well. Thank you.